Hi, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. For today's mortgage rate update, unfortunately, I'm in a position of having to give some relatively bad news. On the rate step chart, we are 3 steps above the bottom level rates. Now, the bottom level step represents the best pricing that we saw. It first came up in early March and then popped up again in the beginning of May. Those levels we are now a little bit further away from than we were on Friday. On Friday, we were on the second step above that bottom line level. So pricing is a little bit worse today than it was at the end of last week. Why? Well, we look to the mortgage bond market. What we've got today is on the 30-year mortgage bond coupon at 2.5%. We see that price levels have fallen from last Friday at about 103.8 down to right now at the time of this recording to about 103.53. This is a totally different ballpark in terms of this bond price versus where we were at the most favorable levels. Most recently, when we got to that bottom step, our bond price levels had remained on this particular coupon at or above 104 for several days in a row. And then finally, that baked into investors modifying their rate sheets to finally give us the benefit of those high bond prices. As we are seeing the bond prices fall, as predicted, the mortgage investors have been very quick to snap their rate sheets in the upward direction, unfortunately. Now, in terms of scale, it's important to note, this is not, Calamity Monday. Rates are out of control. We're still seeing very favorable rates overall. We're only 3 steps above that bottom level price. So if you are looking to refinance, again, you're going to have to look at that on a case-by-case basis. You're going to want to run the actual cost versus benefit based on the pricing that's available today and make a subjective determination whether or not those savings are worth whatever costs you are looking at for that. Big picture-wise, it's very difficult to tell from a day-to-day basis whether or not we are going to see the rates that we saw all over again. Right now, it's not looking good. We're seeing lower bond price levels today. Now, on Friday, I mentioned that there's this other coupon that's relevant to mortgage pricing. So it's not just this 2.5% coupon, it's also the 2% coupon. On Friday, the 2% coupon was up and the 2.5% coupon was down. And my prediction, based on probabilities at that time, is that I thought it was very likely that today we would see worse pricing. Well, that has turned out to be correct because, in fact, today the 2% coupon is also down at a lower price level versus where we were at on Friday. What is driving this behind the scenes today? Basically, we have a classic supply-demand problem. The Federal Reserve, which is the single dominant factor controlling where mortgage rates are at right now with their bond purchasing program, they're buying less in overall mortgage bond volume. Today, the spigot ran out at about noon Eastern time. We have seen a pattern before, particularly when it was very volatile, where when the Fed bond buying program was active during the day, the bond prices would be at a nice level, sustaining good pricing. And then as soon as they would turn that spigot off, we would see an immediate impact on investor rate sheets, and you'd have worse pricing in the afternoon than you had in the morning. There is overall this supply and demand problem right now, though, where although the Fed is buying bonds, they're not buying as much. And you had some numbers I looked at today said on the sell side, 11 billion in these mortgage bonds are up for sale. The Fed bought about 3.2 billion. There are all sorts of other asset categories where bond investors can go to buy, including some new long-term US Treasury debt, which is different than these mortgage bonds. There was some news about a week and a half ago that the U.S. Department of the Treasury was opening up a new pool of long-term mortgage bonds. I had indicated that at the time that this would be probably bad for us on the rate side because there's a whole other asset class that is in direct competition with the long-term mortgage bonds. I predicted that in all probability that would put pressure on the mortgage bonds, reducing those bond prices, which of course brings rates up. So again, nothing calamitous to report today. It'll be interesting to see how this pans out. What we might be looking at this point is a pattern that we've seen several times over, which is we see a real bright spot in the rates. We got to that lowest level on the stair-step chart, and then there's a move back up. The question is, how long will this last? How high will the rates get? And will this pattern continue where we see an upward trend followed again by another lower trend? I will keep you up to date. Please, I would love to take a look at any of your scenarios, whether it's a purchase, whether it's a refinance. I have to thank everyone again for watching these videos and for reaching out to me. I've secured a really good amount of business on the purchase side and on the refinance side just by introducing myself to people through these videos. So if you have any questions, please let me know. You can call or text me at the number below anytime. Please like the video, subscribe to the channel, and share this content with anybody that you think might find it useful. Thank you so much. Have a great week.